Hello and welcome from me, Philip Nothard and Kurt Hutchinson to this week's special Motor Trade Radio podcast brought to you in association with eBay Motors Group. Many thanks again for joining us in this 12th in our series of special interviews sharing best practices as car retailers manage their way through COVID-19 crisis. Previous interviews with people such as Sytner Group's Owen Edwards, Virtue Motors' Robert Forrester, Peugeot UK boss David Peel, and our chat with Marshall Motor Group's Dash Gupta, recorded on the day of the showroom's reopening in England, are still available to stream online from motortraderadio.com, Spotify, Apple and Google Podcasts.
So today we're delighted to welcome our special guest, Owen Edwards from Grant Thornton Automotive Advisory Team. Welcome back to the podcast, Owen. And perhaps you could start by giving listeners just a brief overview of your automotive remit at Grant Thornton.
Yeah, sure. Hi, Kate. Hi, Phil. Thanks for having me back on again. It's a great opportunity to be back on the podcast. So basically, I work for the Automotive Advisory business at Grant Thornton, and that's part of the business consulting. So we are really a consulting part of Grant Thornton, which, as you mostly will know, as the auditor and tax people, but as well, we have an advisory business. And what we tend to do is we tend to work in the section of what's known as a downstream. So the downstream is from the factory gate out to the end consumer. So that includes fleet leasing, dealers, a specialist area of ours, and consumer finance and asset financing as well. And basically what we do with the dealers is we work in a number of areas. So we look at cash management and what's happening in the way of cash management for those businesses, business planning, which is what we will be talking today about, and then improvement in performances with new vehicles, used vehicles, and after sales profit clinics.
Well, I mean, welcome, Owen. And I mean, the reason that for getting you back on this show, and just to give the listeners a bit of context around what we're going to talk about, is you recently, just ahead of the showrooms reopening in England on the 1st of June, released a blog to coincide with the car showroom reopening, and the title was 3 Actions to Improve Automotive Viability, which generated some very positive interest and comments, especially through LinkedIn. So taking each action point in turn, let's start by with ensure cash flow remains strong and in control. We know cash is king, but dealers have just come out of the forced period of showroom shutdowns. What are your observations on how cash was managed during this period? In terms of things like the follow-ups, positive impact on workshops, etc., and obviously the end of the shutdown period, and obviously click and collect.
Yeah. So what I'd say is many thanks for all those people that commented on LinkedIn. I certainly didn't expect that people to comment on it too much. I just assumed that it was just one of those things that went out there. But I think what we've seen at the moment, if you look at the cash and the cash management of the business, to start on that bit first, I think the situation is that in the document we didn't want to just cover where the cash flow was at the current moment in time, because if you look at the businesses and how they sit out there sort of pre exit of lockdown, those businesses were still burning cash, but the level of cash was sort of minimised to a certain extent. So there was furloughing, for example, there was civils, there was mortgage holidays, etc., etc. And in that period of time, yes, there wasn't any revenues, and yes, there was some cash burn. It wasn't what we would classify as the area of highest risks. So what do we mean by that? What we mean is, as we come out of lockdown, clearly costs go up quite dramatically because you're bringing back in staff, you're bringing back in the technicians, you're bringing back in the salespeople and the administration people to run the whole operation. And the issue around that is that your revenues aren't growing as fast as probably what they were pre-COVID, and are only growing at a very slow rate, which is sort of what we've seen with the SMMT results of registrations. Now, the big issue around that is that you're also driving towards the half year as well, and then pushing towards September, when you need to have that cash to buy the stock and to generate the working capital. So you need to be very much on top of that cash and that cash flow, because If you're not, it can quite easily run away from you. So therefore, what we were suggesting in the LinkedIn document was really, focus very heavily on that cash flow and where that cash flow is going. You may have to forecast it, for example, and that's one of the things that we would recommend, that you take a proactive stance and forecast. You might not necessarily make one forecast, it might be 3, 4, 5, but at least you've got some form of datum to work from, and roughly where your cash will go across that scenario analysis. You've got to keep reviewing that cash at all times. So that's sort of what we would look at in the way of our first bit, where cash flow remains strong and in control.
And just before moving on, in terms of because obviously there's been government grants, there's been government support. We know that the banks have been behind a lot of the businesses throughout this sort of lockdown period. Do you think that's a risk of giving a false sense of security around cash, or not? What's your view on that?
Yeah, I think it is. I mean, I think the big issue that you've got, so for example, if you've had a mortgage holiday or you've had a rent holiday, don't forget that all comes back. You're not going to have that forever. That cash flow will then come back at some point in time, and it could be a situation, if you've had a holiday, your interest costs rise, for example, on your mortgage. So you've got to be aware that these, you've had this period of what we call cash dormancy to a certain extent, where there's not so much cash burn taking place. And then what you'll have is, with your working capital rising as you bring back your costs, and then on top of that, you've got things such as your mortgage kicking back in. You've probably got higher interest rate than what you had, or interest payments than what you had before, because you've holidayed it. So there is this sort of falling cash to start with, sort of plateauing out of cash a little bit as the companies get this sort of form of cash leveled out, and then cash will get burnt at a greater rate after that, as revenues don't grow as fast as the cash being burnt.
Now, Owen, the second action point that you proposed was creating a business plan for viability. So I just wondered how that is different from what would be a normal business plan, and how you're advising dealers to approach it, and also the timescales, because you've already highlighted the importance of going into September with cash. So what's your thinking behind this?
Yeah, so at the end of the day, we looked at it in the aspect of what we call grip and vision. So grip is actually having real control on the company and really focusing down on the fundamentals of the company, and I'll highlight that in a minute, what the 5 key ones are. But what we do is we say, at the moment, you should be probably in a position where management has got 90% grip and 10% vision, so 10% vision being the strategy going forward. And it's absolutely imperative that focus, that there's that real strong focus, that 90%. As we come out of the COVID situation that we're in, it might be a new norm, as people are saying, but then slowly you progress from 90-10 to 50-50. So you get back to what would be your normal level of grip and vision, 50-50. So what we're suggesting is that you do a 3-month rolling. So this is a 3-month rolling business plan. You need to do your P&L, you need to do your balance sheet, you need to do your cash flow. Now, just because you've done 3 months, that doesn't necessarily mean you don't do any more. What we suggest you do is, if historically you've done 1 month already, you've got 2 months that are rolling future, put another month on the front, and again, you'll have that 3-month rolling, because that still maintains that level of focus, that level of grip. So what are the sort of areas that we would recommend you look at, and how can you implement that in your business? I guess the next sort of process is what we were trying to highlight in our document. So the areas we would look at is volume. So it's new, used, after sales, where the volume is. It's basically the very top line. We then recommend you look at the margins and see what's happening with the margin structure. We would then say costs and overheads to look at. Fourth is your head count, and fifth is that key crucial one, which is your cash. And then when focusing on that, what we would recommend is you have to implement that in a very strict way. So we would recommend only on volumes, to have daily operational control meetings, because volumes can be changed on a day-by-day basis. So, the sales team, for example, they know what the target is. So day one, this is your target, this is what you've got to do tomorrow. Okay, day 2, you come and have another meeting. This is what you did. This is what you didn't do. So you've got absolute control on where your volume's going and how you can push that forward as strongly and hardly as you can. The other areas that we would then focus on is a weekly control, so a weekly operational control meeting, and you'd be looking at your margins, your costs, your headcount, and your cash in that particular area, because they're less flexible than volume. Okay, and then finally, you'd want a monthly. So you'd want one in the middle of the month, and then finally, you'd want one towards 3 days towards the end to make sure that all people in the business know, especially what's happening with the volumes, and the senior stakeholders know what's happening, all 5 of those criteria of, volume, margin, cost, etc.
And there's some interesting observations there, Owen, around volume, because that is the big unknown at the moment, isn't it, in terms of both used, which we expect to be high, but could be constrained by supply, and new, we don't know because of factories reopening. So more regular meetings there, so it seems to be the key.
Yeah, and what I would say is, when you're building this business model, it doesn't necessarily have to be one model. Make it as flexible as you can, because you want at least a minimum of 3 scenarios. You want a sort of a worst case, a mid case, and a best case.
Yeah.
And I mean, you mentioned earlier the new norm, and that is obviously what people are referring to, and we're potentially going to be entering a period of unknown. It's a new era for everybody, and it sort of leads us on to the third action point, which is about reshape for the future. And I mean, take us through some of what that covers and your thoughts around that reshape for the future advisory is.
Yes, when we put that out, the dealers hadn't quite gone back into the opening up from lockdown. So our initial thoughts were, for example, really early stages. After sales, we need to get the after sales back quickly and efficiently and effectively, because that's where your high level of gross margin is, and that's a good cash generator as well. And that comes down to this cash level. On those aspects, focus really heavily with the the after sales advisors to actually, book in those MOTs that should have been booked in, book in the services that were pre-COVID. People are still going to need their mileage done, their service done. I still need mine to go back to the dealership, So in the after sales, really focus heavily on that. You need to have good customer experience as well. So, if people are trying to get in contact with you online, react quickly, react fast. Don't let them hang around. In the way of sales, that's clearly going to be a different process, and who you bring back and at what time is really very dependent on the dealership, because one, due to PPE and distancing. So in the way of sales, what I would suggest there is that, don't forget, things are different to what they were. You may now have to, for example, invite people into the dealership. It may be on a one-to-one basis. There may be only a certain number in the dealership. You're going to have things like click and collect. You have to be very efficient. You're going to get more interest over the internet, and therefore, as I say before, it's all about customer service. Respond as quickly as you can. But clearly, that very much depends on the type of resource that you've got and the actions that you've got. So I think fundamentally, you need to make it as easy and as simple as possible for the consumer. And the reason for that is because at the current moment in time, we're seeing consumer confidence being very, very weak. So consumer confidence, we look at the consumer confidence index, that's minus 34 at the moment. That's getting pretty close to where we were in 2007 in the major recession. So, with that business, with your business, focus on your cash flow, focus on getting it back and running, but in the new norm. So, i.e., more online, be more adaptable, and really give the best practices to the customer that you can.
Yeah, Owen, many thanks for taking us through the 3 action points there for automotive business viability. And it's probably worth mentioning to listeners, they can find that on the Grant Thornton website, as well as heading over to your LinkedIn page, because it's posted there as well. Yeah. But we thought, as we've got you on, we'd ask you a couple of other questions, because clearly there's so much happening in the market at the moment. Yeah. Now, you've spoken before on the podcast about industry consolidation, but I just wonder what your take is on how the COVID crisis could actually accelerate the process. And by way of background, over the last week, we've had Robert Forrester at Virtue making it quite clear that the group was well positioned to take advantage of any opportunities which will arise in terms of consolidation. And last week on the podcast here, we had Dash Gupta from Marshalls telling us the crisis would accelerate consolidation and actually see the emergence of 5 or 6 5 billion to 10 billion pound super groups over the course of the next 5 years. So I wonder what your take is on the likely course of for consolidation now.
Yeah, that's an interesting question. I mean, consolidation, will it continue? Yes, I think it will continue. As we saw when we came out of the last recession, it picked up quite dramatically in 2012, 13, 14 and 15. And I think fundamentally, you're still going to have the three main areas of the market consolidating or buyers in the market. Firstly, the private buyers. So we would expect to see, one-to-one, one dealership here, one dealership there. Those are the private buyers buying up and generating their own contiguous market area approach, as we call it. But be careful, make sure you've got the cash to support that, because at the end of the day, you will be burning quite a lot of cash at the start. So jumping in is not always the best thing to do. It might be worth just delaying it a little bit in that aspect. Overseas, we could see some overseas, although, dare I say the word of Brexit, that's still sitting out there on the horizon for December. So we may not see so much in the way of the overseas buyers out there at the moment. They might more likely come back at next year or the following year. But I think there may be some cheap assets out there that they would gain the benefit from. And then finally, I guess it's the PLCs, as you mentioned some there. I think when looking at the PLCs, I think, clearly prices are not what they were. So one would assume that the PLCs would go for the cheaper assets or would be better valued. There will be, I'm sure, without a doubt, assets that are out there to be purchased that have been hit by the COVID environment. They've run out of cash. But what I think across all of the buying or any consolidation in the market which will take place, it really needs to be thought through very carefully whether some of these businesses are actually viable at all. But yeah, I totally agree. There will be consolidation. Is it going to be 10 billion plus turnover companies? That's an interesting question in itself. There is possibly the possibility of that, without a doubt. I would say, however, again, looking at the viability of such companies, they need to have controls in that enable them to run such a large business. It's done in America, it's done in China, so it's feasible that it might well be done in the UK. I think you've got to take into consideration the OFT, Office of Fair Trading. And of course, don't forget, there's also another party to this as well, not just the dealers, there's also the manufacturers as well, and their thought process around that.
And finally, I mean, we're talking just after the new car figures for May have been published, and we're down 89%. We're just over 20,000 registrations. Surprise to some, maybe not everybody. The latest results for used is that we were down 8.3% at the end of the first quarter, and across the EU there's been a variety of results for May. Italy being down just over 49%, Spain being down 72%, and various others. But what's your take on how you think the new used car market will perform in the short, medium, and potentially the long term as a consequence of what we've just been through?
Yeah, so I think that's the $64 million question that everybody's asking, really, to a certain extent. So how did I know you were going to ask me that? So I think the situation in the new car market, I mean, we're never going to be forecasting a precise number. So what we do, as I said to you before, we do a range, and we put a range out a couple of weeks ago, and we'll be putting one out in the next week or so. And if you want to get that range month by month, look up me on LinkedIn, and we can supply that to you. But to give you a feel, what we have is 3 case scenarios for the new car market 2020. We have the worst case, which we think is about 1.4, 1.45. We then have a mid case of about 1.5, and then we have a best case, which is somewhere in the region of about 1.68. So that's broadly in line with the SMMT that's out there as was. Then what I would say is, where's the used car market going to go? Well, that's a really interesting one. That's again another $64 million question. I think what we're going to see initially is volatility in that market, as that market tries to find its feet in trying to balance itself in equilibrium between demand and supply. I don't actually have a number for the used car market. I think there's other people out there that are going to have significantly better knowledge about that than myself. So therefore, that's not one of the things that I really want to put out there. But what I would say is I think as time goes on, you will see a balancing back into that used car market. It is very much demand stroke supply led and not pushed into the market by any means, as possibly some of the new cars are. So I think fundamentally, I can't really over answer that, only that we do have this range of the new vehicle.
No, it's very difficult. I mean, there's so many variables through supply, defleet, what's happening in the leasing, contract hire sector. There's conversations currently taking place between many of the trade associations and the UK government about how there's the stimulus behind that, and whether that's purely new, what that would look like in the new car market in terms of remaining on that green agenda. And then if there's also conversations taking place around a used car stimulus requirement for the sector. So there is so many variables, and that's not just in the UK. It's publicly in the market there about obviously what's happening over in Germany and things like this. So no, I get that. I mean, clearly, it remains me to say thanks for coming on. I mean, clearly there's we are entering, as you described, the new norm. I think this is a case of everybody's entering a new period in the business. Nobody knows what the short-term, medium-term landscape will look like. As we come out of restriction, and you mentioned it earlier, we're back onto the B word, unfortunately, Curtis. But we've got the Brexit now looming again. But I think clearly it's about you guys giving some advice, helping the dealer market and the automotive sector in general to start to put measures in place to help them through this as best possible, whether that's handling cash flow, viability, and monitoring results and performance volumes either through new, used, or after sales is obviously key for any business.
And I agree with you, and I think it's absolutely critical that as I say, over the next few months, which you've got running from June, July, August, September, pushing into that period where working capital goes up, stock rises, part exchange vehicles come back in. You've really got to. The best advice I can give is that cash still remains king, and that you do really understand where your cash flow is going, and you actually forecast it and business plan for the future, because it doesn't have to be for the next 5 years by any means. That's the wrong way of going around it. At the moment, we talk about grit. That's what we need. What we believe you need to have on the company is good grit.
Yeah, well, many thanks for joining us, and great to have you back on the show. And just to remind anyone listening that they can find your blog on the Grant Thornton website and on your LinkedIn page. So many thanks for joining us, Owen.
No problem at all. Thank you.
Thank you.
So unfortunately, that's all we have time for now. You've been listening to this special Motor Trade Radio podcast brought to you in association with eBay Motors Group. Please like and share on social media, as it's important during these times for the dealer community to work together and share experiences and best practices. Many thanks to you for listening and supporting the podcast. Philip and I will be back with the industry headlines on Saturday, but do watch out for more of these special podcast interviews as we work through this crisis. Until next time, stay safe and stay well.